So in today's deep dive, we are looking at this massive stack of expert analysis on retirement planning strategies.
Oh, yeah, it is quite the stack.
Yeah, I mean, we've pulled together research, tax tables, all these financial planning frameworks. And our mission today is to demystify a tool that is, well, it's incredibly powerful, but it just gets skipped over way too often.
Right.
And that is the Roth 401k.
Yeah, the Roth, it's a big one.
But, before we get into all the complex tax codes and the withdrawal strategies and all that, I want to ask you a quick question.
Okay, shoot.
So you ever rent a car at the airport?
Yeah.
And, the agent asks if you want to prepay for the gas or if you just want to bring it back full.
Oh, man, yeah, the classic standoff at the rental counter.
Right.
Yeah, you stand there doing this frantic mental math like, oh, if I prepay, well, it hurts right now, but I can just, toss the keys and run for my flight later.
Exactly.
But if I don't prepay, I save the money today, but then I'm gambling that I'll have the time to find a gas station near the airport.
And that you won't get lost.
Right, and that gas prices haven't completely spiked by the end of my trip. It's stressful.
It is. It's a surprising amount of psychological pressure for like a random Tuesday afternoon.
Seriously.
But I bring it up because we are taking that exact same dilemma, paying now versus paying later, and we're applying it to literally the single biggest financial trip of your life.
Yeah, which is, that's just a perfect way to frame it because honestly, most people just default to the traditional 401k that their employer offers.
Yeah, you just sign the paperwork.
Right. You get the onboarding packet, you check the box for the traditional plan, you grab whatever employer match they offer, and you literally never question it again.
Never.
Because the Roth option, it just feels like this entirely different, complex beast that nobody wants to deal with.
But they're fundamentally the same engine under the hood, right?
Yes.
Like both are employer-sponsored, both let you defer your salary,
Yep.
both take an employer match.
Right, exactly.
So we don't need to rehash the absolute basics of what a 401k is because, our listeners know that. What we really need to establish first is the core distinction between the two.
Yeah, the only real distinction, the absolute fundamental difference between them is the timeline of taxation.
The timeline.
Yeah, it is entirely about when you pay the toll to the IRS. So with a traditional 401k, you are making pre-tax contributions.
Meaning before the IRS gets to it.
Right. You put the money in before income taxes hit, so it reduces your taxable income in the current year, giving you a break today.
Okay.
But, and this is the big but, you pay ordinary income tax on every single dollar you withdraw in retirement, and that includes all the growth.
Okay, so that's waiting to pay for the gas after you bring the car back.
Yes, exactly. You're paying at the end. Now, a Roth 401k, in contrast, is funded with after-tax dollars.
Okay.
You pay your income tax up front, right out of your current paycheck. The money goes in after the IRS has already taken its cut. So because you've already paid the toll, the defining benefit is that the money grows tax-free.
Wow.
And when you finally take those withdrawals in retirement, the withdrawals are completely tax-free.
Okay, that sounds amazing, but there is always fine print with the IRS.
Oh, always.
So what's the barrier to entry for those tax-free withdrawals? What's the catch?
It's actually a pretty straightforward two-part test. First, the account must have been open for at least 5 years.
Okay, 5 years.
Yeah. And second, the withdrawal must happen after a qualifying event, which typically just means reaching age 59 and a half.
59 and a half.
Right. The government's logic here is simple. They want to incentivize long-term retirement savings, not create some sort of tax-free day trading account for people in their 30s.
Right.
You have to commit to the timeline.
Okay, so 5 years and 59 and a half.
Right.
I've got it. But here is where I want to push back just a little bit.
Yeah.
Based on what we see in these sources. Because the conventional wisdom, the thing you hear from literally everyone, is that you will probably be in a lower tax bracket when you retire.
That's what they say.
Right, because you stop working, your income drops. So logically, deferring taxes with a traditional 401k and paying them when your rate is at its absolute lowest, that makes total sense. Why on earth would I pay taxes today during my peak earning years?
Well, see, that assumption right there is the biggest trap in retirement planning.
Really? A trap?
Yeah, and to understand why, we have to look at what I call the domino effect of traditional 401k withdrawals.
Okay, lay it on me.
When you defer all your taxes to the front end, that burden lands squarely on you in your 70s and 80s.
Right.
Every dollar you pull out of a traditional 401k just to, buy groceries or pay property taxes, it increases your overall taxable income for that year.
Oh, because the IRS treats withdrawal from a traditional 401k exactly the same as like a W-2 paycheck.
Spot on, yes. And this happens at the exact moment in your life when you desperately need to keep your adjusted gross income, or your AGI, as low as possible.
Okay, wait. So what are the actual mechanics of that? Aside from just, paying the income tax itself, what is the fallout of artificially inflating your income when you're retired?
It dictates your eligibility and your costs for almost everything else in your financial life. Let's look at Medicare first.
Okay.
A lot of people just assume Medicare is a flat rate for everyone.
Yeah, I think I assumed that.
Most do. But it is not. Your Medicare Part B and Part D premiums are tied to your income through something called IRMAA.
IRMA.
Yeah, IRMAA. It stands for the Income-Related Monthly Adjustment Amount.
I actually saw this in the research. It's basically a surcharge if you make too much money.
It's a massive surcharge.
Right.
And what's brutal about IRMAA is that it operates on what they call cliff brackets.
Cliff brackets, like you fall off a cliff.
Basically, yeah. If your traditional 401k withdrawals push your income even one single dollar over the threshold for the next bracket,
$1.
just $1, your Medicare premiums spike for the entire year.
Oh, wow.
You don't just pay more on that $1, right? Your whole baseline for healthcare costs jumps significantly.
That is wild. So you're telling me pulling an extra, I don't know, $1,000 out of my traditional 401k to go on a vacation could accidentally cost me thousands in extra Medicare premiums.
Yes. That happens to retirees literally every single day.
Man.
And it gets worse when we look at Social Security.
Oh, no.
Yeah, up to 85% of your Social Security benefits can actually become taxable if your income is too high.
Wait, walk me through that, because I've spent my whole life paying the Social Security tax out of my paycheck,
Right.
and now they're going to tax the benefit when they hand it back to me?
They are, and it's based on a formula called provisional income.
Provisional income. Okay.
So to calculate this, the IRS takes half of your Social Security benefit and adds it to your other taxable income.
Right.
If that combined number crosses certain thresholds, which, by the way, haven't been adjusted for inflation in decades.
Of course they haven't.
Right. But if you cross them, suddenly 50% and then up to 85% of your Social Security becomes taxable.
And since traditional 401k withdrawals count as taxable income, they just feed directly into that formula.
Exactly. You're pulling money out of your own savings to live on, and in doing so, you are inadvertently triggering a tax on your Social Security. It's this whole cascade effect.
Okay, this completely reframes the Roth 401k for me,
Yeah.
because it stops being just a savings account and it kind of turns into a shield.
Oh, that's a great word for it.
Right, because I already pay taxes on the money going into the Roth, so those withdrawals don't count toward my adjusted gross income.
That's the power of the Roth. It is invisible income to the IRS.
Invisible income.
Yeah, if you pull $80,000 out of a Roth 401k to live on, your taxable income for that specific withdrawal is zero. You stay under the Medicare IRMAA cliffs. You keep your provisional income low enough that your Social Security remains largely or, even completely tax-free.
So when the experts talk about supercharging your retirement, it's really a defensive strategy.
Virtually, yeah.
Like you're protecting your other benefits from being cannibalized by your own savings.
Right, but it's also highly offensive. The research we're reviewing dives pretty heavily into active strategic advantages too, specifically this concept called tax diversification.
Okay, I want to talk about this because I was thinking about how to visualize this for a listener.
Okay, let's hear it.
It's like, imagine you're traveling internationally, right?
Yeah.
And you have this custom wallet that holds US dollars, euros, and yen.
Okay, I'm with you.
Now, you don't know what the global markets are going to do next year, but you have purchasing power in all three.
Right.
So when you go to buy something, you have the power to pay in whichever currency currently has the strongest exchange rate, effectively getting a massive discount.
That is a phenomenal way to picture it. Tax diversification is exactly that. It's having your money spread across 3 different currencies or tax treatments.
Right.
You have taxable accounts, like your standard brokerage accounts where you pay capital gains.
Okay.
You have tax-deferred accounts, like the traditional 401k. And you have tax-free accounts, which is the Roth.
So the goal isn't just to pick one winner and put all your chips there. It's to hold all three currencies.
Exactly. Having all three gives you incredible control. I mean, think about how often tax laws change just depending on who is sitting in Washington.
Oh, constantly.
Right. If you only have a traditional 401k, you are entirely at the mercy of whatever the income tax rates happen to be in the year 2045 or whenever you retire.
Yeah, that's scary.
But with a diversified portfolio, you become the master of your own tax bracket.
I see. So if tax rates skyrocket across the board, or, if I want to pull out a huge lump sum to buy an RV without spiking my bracket, I spend the yen.
You spend the yen.
Right. I pull from the Roth bucket because it's completely insulated.
And conversely, let's say you have a year with unusually high medical deductions, or maybe your baseline income just drops, so your effective tax rate might basically be zero.
Right, yeah.
In that scenario, you pull from the traditional 401k. You essentially wash those distributions against your deductions and pay no tax anyway. You get to optimize your liability year by year.
Man, that's smart. Now, speaking of control, I did spot something in the tax codes while reading these sources that seemed, well, contradictory to me.
Oh, yeah? What's that?
I'm looking at the rules for required minimum distributions, the RMDs.
Ah, yes. RMD.
The government forces you to start taking money out of your 401k at age 73, whether you want to or not.
Right.
And surprisingly, the Roth 401k is subject to these RMDs too. Doesn't being forced to liquidate your account completely defeat the purpose of having total control?
It's a really great observation. And RMD is essentially the IRS saying, you can't shelter this money forever. We want this money moving in the economy.
Right. They want their cut, or at least they want action.
Exactly. And yes, traditionally Roth 401ks have been subject to RMDs. However, there's a completely legal, highly effective structural workaround.
Oh, I love a good structural workaround. Let's hear it.
It's surprisingly simple. Before you hit RMD age, you just roll your balance from the Roth 401k into a Roth IRA.
Wait, just move it from the employer-sponsored plan to an individual plan?
That's it.
That's all it takes.
That's all it takes. And to understand why this works, you have to look at how the government views these different accounts.
Okay.
A 401k is a workplace benefit. It was legislated to encourage workers to save for their own living expenses in retirement.
Right.
Not to create some permanent multi-generational tax shelter for your heirs.
Right, they want you to spend it on your retirement.
Therefore, the rules force you to spend it. But an IRA, an individual retirement account, that is your personal property.
I see.
So the IRS treats Roth IRAs differently, and they are completely exempt from RMDs during the original owner's lifetime.
Wow. So by doing a simple rollover, the RMDs just vanish.
Poof. Gone.
The money can just sit there compounding tax-free until I'm, 95? Or I can pass it down to my kids without ever being forced to drain it.
It gives you 100% authority over the timeline of your own money.
Okay, we have built a massive case for the Roth here today.
We really have.
I mean, it protects Social Security, it dodges Medicare surcharges, it gives you currency-level tax control, and you can totally bypass RMDs.
Yeah.
But, a good deep dive requires objectivity, and we need to look at the mathematical reality here.
Absolutely.
I want to play devil's advocate for just a second.
Go for it.
Let's look at the actual math of a contribution, because there is a huge misconception out there. People assume the Roth magically generates more money.
Let's run the numbers, because this is where the mathematical illusion happens, and it trips a lot of people up.
Okay, let's do it.
So imagine you have a $10,000 chunk of gross salary you want to invest.
Okay, 10 grand.
Let's assume your tax rate today is 20%, and your tax rate in retirement stays exactly the same at 20%.
Okay, so we're keeping it identical just to test the mechanics of the accounts.
Exactly. So with a traditional 401k, the full $10,000 goes in because it's pre-tax.
Nice and easy.
Let's say over 30 years, it grows by a multiple of 10.
Okay.
You now have $100,000 in your account.
Incredible.
Yeah.
I'm rich, but the IRS is waiting for me at the rental counter.
They are waiting right there. You withdraw that $100,000, you pay your 20% tax, which is $20,000, and you walk away with $80,000 net in your pocket.
Okay, $80,000 net. That's from the traditional. Now, run that exact same $10,000 gross salary through the Roth.
Okay, so with the Roth, you have to pay your 20% tax up front on that $10,000 gross salary.
Before it even hits the account.
Right. That costs you $2,000. So you only actually deposit $8,000 into the Roth 401k.
Got it.
Now, we apply that exact same 10x growth multiple over 30 years. Your $8,000 grows to $80,000.
And since it's a Roth, I pay zero taxes on the withdrawal.
Zero.
I just walk away with $80,000.
Exactly. $80,000 from the traditional. $80,000 from the Roth.
Wait, it's mathematically identical?
It is entirely identical. If tax rates stay exactly the same, neither account actually creates more wealth than the other.
That is fascinating because I think this trips people up. They say, wait, if I pay taxes on the seed instead of the harvest, doesn't having less money going in early on, like, cripple my compound interest?
It is the most common question I hear, but due to the commutative property of multiplication, it just doesn't matter whether you subtract the 20% at the very beginning of the equation or at the very end. The net result is mathematically identical.
So if it's a mathematical tie when tax rates are flat, why is the Roth considered such a powerhouse by all these experts? Is it just a bet that tax rates will be higher in the future?
That is the primary reason, yeah. I mean, historically speaking, U.S. tax rates are currently near historic lows.
Right.
We have a massive national debt. Social Security is facing funding cliffs. Many economists believe tax rates simply have nowhere to go but up.
Makes sense.
So if you lock in your taxes today at 20% and future rates go up to, say, 30%, the Roth wins substantially. But, and this is crucial, there is a second kind of hidden mathematical advantage to the Roth for high earners.
Ooh, okay. Hidden advantage. I like that.
It allows you to effectively cram more money into your account.
Cram more money. How? I mean, the IRS sets strict contribution limits, right? Like,
Yeah.
let's say the limit is $23,000 a year. You can't go over that.
Think about the actual value of those dollars, though.
Yo.
If you max out a traditional 401k with $23,000, you don't actually own $23,000.
Because I still owe taxes on it.
Exactly. You basically own a joint account with the IRS.
Oh, that's depressing.
Right. You might only truly own $18,000 of that value once the deferred taxes are finally paid.
Right.
But if you max out a Roth 401k with $23,000, you own every single penny of it.
Oh, I see. Because the tax was paid with outside dollars, like from my checking account, I have basically managed to stuff a full $23,000 of pure, unencumbered value into a tax-advantaged shell.
Exactly. By using a Roth, you are effectively increasing your maximum contribution limit. You are sheltering more real purchasing power than a traditional 401k legally allows.
Man, that is a brilliant way to look at it. Okay, so we understand the mechanics. We know the defensive benefits against the Medicare and Social Security traps, and we understand the mathematical leverage now.
Right.
But it all comes with the upfront pain of smaller take-home pay today.
It does.
So how does a listener actually decide which path to take? Because there's a lot to weigh here.
Well, based on all the financial planning frameworks we've reviewed in this stack, it really boils down to 3 diagnostic questions you just have to ask yourself.
Okay, hit me with them.
Question 1. Do you expect to be in a lower tax bracket in retirement?
Well, the first one seems obvious now. I mean, if I'm a high-powered executive making peak income right now, but I plan to retire early and, I don't know, move into a tiny off-grid cabin in the woods, I want the traditional plan.
Right.
I take the tax break when my bracket is highest, and I pay the tax later when my income is tiny.
Exactly. That's the classic use case for the traditional 401k.
Okay.
But what about the reverse scenario? That's question 2. Do you expect your personal tax rate to rise over time?
Which could be because you're young and in a lower bracket right now, but you expect your career income to, grow dramatically.
Yes. Or maybe you expect you'll have fewer deductions in retirement. I mean, your mortgage is paid off, the kids are out of the house.
Right, no dependents.
Exactly. Without those deductions, your effective tax rate goes up even if your gross income goes down. So if you expect your rate to rise, the Roth is the clear winner.
Got it. And the third diagnostic.
Question 3. Do you want to hedge against legislative risk? If your primary goal is protecting your wealth against sweeping government policy changes or maintaining strict control over RMDs and Medicare premiums, you choose the Roth.
Or, based on what we talked about earlier, you choose both.
Choosing both is the ultimate pragmatic strategy, honestly.
Yeah, the research explicitly highlights this. If you are stressed out trying to build some crazy spreadsheet predicting what the U.S. tax code will look like in 2055, just stop panicking.
Seriously, put the spreadsheet down.
You can just split your contributions. Put 50% in the traditional, put 50% in the Roth. You automatically build that international currency wallet we were talking about, so you have options ready to go when you retire.
And we should probably briefly note, as our sources always emphasize, that this analysis is educational.
Right.
Tax strategies are highly dependent on individual circumstances, and the laws are constantly shifting. It is always a good idea to consult a qualified tax professional before restructuring your entire retirement plan.
Yes, absolutely. We are guides to the mechanics. We are not your personal accountants.
Exactly. And the most vital takeaway the experts stress is simply to save and invest consistently, regardless of which vehicle you actually choose.
Right. Action beats optimization every time.
Every single time.
So, as we wrap up this deep dive into the Roth 401k, I want to hand it over to you for just a final thought. We've covered IRMA cliffs, provisional income formulas, the math of compound growth.
Yeah, we've covered a lot.
What is the one thing you want the listener to walk away with? Something that maybe sits beneath all these percentages and rules.
Yeah. I think if we look at the core of what we've discussed today, it's really about risk and assumptions.
Risk and assumptions.
Right. We spend so much time obsessing over market risk. We track the S&P 500. We worry about recessions. We worry about inflation.
Oh, constantly.
But we rarely question the stability of the tax code itself.
Wow. Yeah, that's true.
If you're assuming a traditional 401k is the safest bet simply because it gives you a refund today, you're making a massive, multi-decade gamble.
It's a huge gamble.
You are betting that income tax rates, the complex thresholds governing Medicare, and the taxation of Social Security will all stay exactly the same, or maybe even become more favorable by the time you retire.
Which seems unlikely.
Given the trajectory of national debt and entitlement programs, that is a highly risky bet.
Yeah.
So by utilizing a Roth, you aren't just saving money. You are essentially buying financial certainty in an incredibly uncertain future.
You're prepaying for the gas.
You're prepaying for the gas.
So that when your trip is finally over and you roll up to the drop-off counter of retirement, you could just toss them the keys and walk away, completely free and clear.
Exactly.
Well, that's definitely something to think about next time you check your pay stub.